In this session, I'm going to give you a small example to understand what are financial statements, because it is those financial statements which are analyzed by the bankers to understand the financial standing of the customer. Okay. Now let's go through this process. Let's say you are going to start a business with 100 lakhs, say in foreign currency, it's 10 million. Now you are going to start a business, but we have to understand there is a concept called business entity concept. Now, what does this business entity concept means? It means the owner is different from the business. Owner, we call him as natural person, whereas business is called as artificial person. It means there should be a clear line of segregation between the individual and his business, owner and business. Okay. So whatever the business you start, let's say I'll call it as Messrs. X and Co. It means this business has borrowed 100 lakhs, say that is 10 million from the owner. Okay. Say owner name is Mr. A. So Mr. A has given a capital of 100 lakh to Messrs. X and Co. And this 100 lakh is now available with Messrs. X and Co. in the form of a cash because they have not yet consumed. So now I have prepared a simple statement where on one side I have shown from where this money had come to this business, that is from Mr. A's capital 100 lakh, and how that money is available now. It is available in the form of a cash 100 lakhs. But how long they can continue the show like this? Because Mr. A has not given his money to Mrs. X and Co. to simply keep it as cash. It got to be used for some productive purposes. It means it should take some other shape. It should not remain as cash. Let's say this business wants to purchase plant and machinery, land and building because they want to kickstart, but for that they are in need of 150 lakhs. That is, say, 15 million. Okay. But what is the capital that is available as of now? It is only 10 million. So remaining 5 million got to be raised. So already they have 10 million, which is from Mr. A, and remaining 50 million, sorry, 5 million should come from, let's say, from others. Will take a loan for it. We call it as bank loan. So see what is happening. Already there is a capital of 10 million, that is 100 lakh. Now there is a bank loan of 5 million 50 lakhs. So both put together, what is available is 150 lakhs 15 million. Now this is available in the form of a cash, but they don't want to keep it as cash. They want to purchase plant and machinery. They want to purchase land and building. So with 150, purchasing plant and machinery for 10 million, that is 100 lakhs, then purchasing land and building for 50 lakhs, that is 5 million. So entire 150 have been utilized. It means if you notice in both the statements, here also the total both sides are same. Here also the total both sides are same. It means the total is getting balanced. So I'm going to give a name for this. And whose statement it is? It is the statement of Messrs. X and Co. And what is the name of this statement? I'm going to give a name for the statement as balance sheet. Because the logic is very simple, the totals are getting balanced, but more than that, this statement shows the sources, that is from where this business Mrs. X and Co has got money, and it also shows me the users, that is where these money have been used. They have raised money from owners and bankers, and that has been used for acquiring plant and machinery and land and building. Okay, but even now it is not yet complete because they have not started any of their activity, production activity, sales activity. Let's see. Let's see. Yeah. Now this firm, that is Messrs. X and Co, they want to purchase material for 20 lakhs. But how do they purchase? Because they don't have any cash with them. Whatever the 150 lakhs, that is 15 millions, they had that got consumed in this process. They don't have any cash. But they want to purchase material for say 2 million 20 lakhs. So what's going to happen here? Again, the money is coming into the business. That is owner, that is Mr. A, is going to contribute say 0.5 million, 5 lakhs, and banks are going to give a short-term credit called cash credit 1.5 million, 15 lakhs. Now let us see what is happening. Already they had a capital of 100. Now this fresh capital of 5 is also coming, 105. Already they had a bank loan of 50. Now this new loan of 15 is also coming. It means on the left hand side we have 170, which is nothing but sum of all this. So this is nothing but sources, and already we have used 100 for plant and machinery, 50 for land and building. And why we have raised this 20, that is 15 plus 5, basically to acquire inventory of 20, that is say purchase materials. Those materials were not consumed, so they are still lying here. So what is happening? The sources are 170 and the uses are 170, but the additional uses now towards inventory, for which the source is capital and the bank CC. Now I said these are all sources and uses. I'm going to give a technical name for this. These sources I can call them as liabilities. Why I'm calling them as liabilities? Because all these money are repayable. Nothing is a donation here. Everything got to be repaid. Capital is repayable to Mr. A when the business is closed. Bank loan is repayable to bank. Bank cash credit is repayable to bank. And if you want to repay, you need money. For that you need resources, and these are all the resources, so we call them as uses. So I'm going to give a technical name for these uses. I'm going to call them as assets. I'm calling them as assets because these are all the items which are going to give future benefit for the business. How plant and machinery will work for the business? It will enable the firm to produce products which can be sold and benefit can be derived. Land and building is a place where activities are being carried and it will continue for a future. Inventory, it is not yet consumed now, it means it will be consumed in future, which can be sold and it can bring back profit. It means all these items are giving future benefit. So I'm going to call them as assets. So I'll put it here. I'm going to call these items as assets, these items as liabilities. It means this is a statement which we technically call as balance sheet. Okay, so we'll write balance sheet of Messrs. X and Co, and we'll write as on a particular date because this is the position on a particular date. But even now this business has not started any of the critical activity. Now let us get into the operating activity. Let us consume this inventory. It is in the raw material form. Okay, now this got to be converted into finished goods. It means we have to engage laborers, we have to incur various manufacturing expenses. For that again we need money, but do we have money? No, we do not have enough money. It means if we want to sell this further, we have to incur some more cost. For that we need money. So let me give you some more information. Process and sell the raw material, bring more funds to meet labor manufacturing expenses. So what I'm going to do, whatever that was available as inventory here 20, I'm going to consume. But in the consumption process I will be incurring other cost. So first let me consume the raw material 20. I'm going to incur labor cost 5 million, or say 5 lakhs, and manufacturing expenses 5 lakhs. It means my total cost is 30. I'm going to sell this for 40. Now let us see what is happening. My cost is 30, I'm selling it for 40, I'm going to make a profit of 10, but in between a question will arise how these guys were funded. Because the raw material was already purchased, but how you are managing the labor and manufacturing expenses. So for that I'm going to assume that Mr. A is bringing in another 10 lakhs. So that money has been used for labor and manufacturing expenses. Okay, now let's see what is happening. Mr. A has brought in 10 lakhs for meeting this labor and manufacturing expenses. So that 10 along with raw material consumed, the total cost worked out to 30, but that was sold for 40. So 40 minus 30, the business is making a profit of 10. Now who is entitled to this profit? Obviously Mr. A is entitled to this profit. Okay. Now let us see what is going to be the exact position. See, already we know this business had a capital like this. That is, let me just clear all this. This business had a capital of 105, bank loan of 50, CC of 15, plant and machinery of 100, land and building of 50, inventory of 20. Now we understand that this business has made a profit of 10. So that profit of 10 should also go to Mr. A, who had contributed the capital. And Mr. A also has brought in additional capital. So to start with, A's capital, already we know it was 105, but he brought in 10 to meet these two expenses. Now the business has made a profit of 10 which he is entitled to. So that is also getting added to his amount. It means the firm called Messrs. X and Co. has an obligation to the owner Mr. A for 105 which he had already contributed, for the 10 which he had contributed during the year for this 5 plus 5, and for the profit made by the business 10. It means the firm has an obligation to pay 125 lakhs, that is 12.5 million, to Mr. A alone. They have also borrowed 50 lakhs, 5 million of bank loan. They have also borrowed 15 lakhs, that is 1.5 million of cash credit. So their total borrowings is 190 lakhs, 19 million. And how all these have been used? We know already it was used for plant and machinery, it was used for land and building. But do we have inventory now? Answer is no, because whatever we had as inventory that got consumed here, so 20 minus 20, inventory balance is 0. Do we have cash? Yes, we have cash. How we got the cash? Look, there is a sales of 40, that is bringing in cash. Then Mr. A had brought in capital, so that is also bringing in cash, right? So what is happening? The sales of 40 plus capital brought in by Mr. A, so both has increased the cash position to 50, but 10 has been used for labor and manufacturing expenses. Okay, so minus 10. So what is the net cash available? It is 40. Okay, now have a look at the overall position. The total liabilities are 190. The total assets, if I add all this, my total assets is also 190. So this is balance sheet. Okay, this is balance sheet of Messrs. X and Co. as on particular date, and this is the income statement for the period, whatever the period, for the period which are covered. Now generally this period will be 1 year. Generally this balance sheet will be prepared as on 31st March, because that is the year end, Now by looking at this balance sheet, we can understand, say we are the banker, now we are looking at the balance sheet of Messrs. X and Co. We can understand that this business has borrowed 125 from the owners and around 65 from the outsiders, and they have used the borrowed money for creating fixed assets of 150 and short-term assets of 40. So now we can understand what is the liquidity position, what is the solvency position, what is the profitability. Three things I'll give it fast. They made a sales of 40, they made a profit of 10. It means profit divided by sales. So I can say 10 divided by 40, they are making 25 profit, 25% profit margin on sales. Now by looking at the balance sheet, I understand that the owner's money is 125, outsiders money is 65. So debt is 65, equity is 125. So debt to equity, if I create relationship between these two, debt divided by equity is 65 divided by 125, and it is a very comfortable situation because the debt is less than equity. We have to worry if the debt is greater than equity, and even there we have a comfort zone. That is, debt can be greater than equity. Say in this pattern 2:1, it means for every 1 rupee of equity, debt can be 2 rupees. It means debt can be twice, or we can even go up to 3:1. For every 1 rupee of equity, debt can be 3 times of equity. But here I'm not doing the calculation, but we can understand that debt is not even equivalent to 125. It is below 125. It means the ratio is actually less than 1. So it's a very, very comfortable scenario. Okay, so that's about debt equity, which talks about solvency of the business. Then we can also understand the liquidity. Look at the liquidity position. They have bank loan, which is 50, and I understand this is a long-term loan, and bank cash credit, which is a short-term loan. Now for liquidity, I'm concerned about the short-term loan and short-term asset. We call as current asset and current liability. Now short-term loan is nothing but current liability. This inventory and cash put together is called as short-term asset. We call as current asset. Now what is the current liability? 15. What is the current asset? It is 40. So what they are supposed to pay within 1 year is 15, and for paying that what they have is 40. It means their current assets are greater than current liability. It is greater than not 1 time, it is even greater than 2 times, because 40 whereas current liability is only 15. So the ratio is going to be very, very comfortable, because for paying 15 they have 40. So we can say liquidity is also comfortable by looking at this balance sheet. Okay, so what we have done, we have understood what is the profitability, we have understood what is their solvency position, is it comfortable, we have also understood what is their liquidity. Now these are all the three broad parameters which we have to understand when we look at the financial statement. Okay, so now by looking at this financial statement, we got a feel of all this. Now let me summarize this. Income statement will communicate what are the sales, expenses, profit, taxes of the entity. More than that, it is going to enable the banker to understand the performance efficiency, both present and past. It will also enable the banks to plan what will be their future turnover, future sales. It means they can do the projections. It will enable the banker to understand what is the fund generating capacity of the business. Now this is very, very important, because sometimes we'll get carried away by the profit, but more than profit, what is important is cash profit. We should also know what is the cash that can be generated from the operations. That we'll get to know when we look at the income statement, profit and loss. Then very, very important, whether they are making the profit from their main activity or other activity. Sometimes it is possible it will be like this. Let's say sales is 10 million. Expenses, they'll say expenses are say something like 8 million, and they report profit. They report profit of 2 million. In this case, while writing the sales figure, they will take a breakup like this. Let's say sales is 7 million. Non-operating income is 3 million. It means the income which is not directly related to the operations of the business, but they made it somehow. So what is happening here actually, by doing this business, their actual sales is 7 million, for which expenses are 8 million. It means they are actually suffering a loss of 1 million. But that loss is covered by this non-operating income of 3 million. So 3 million minus 1 million, this gives a profit of 2 million. The banker should not get carried away with this profit, because this profit cannot be maintained in future, because this is an income from non-operating activity which cannot be expected to recur year after year. So to understand whether the profits are coming from main activity or not, the banker should go through the income statement. Then balance sheet should be studied to understand the financial position, from whom the business entities have borrowed and how those money have been used, and how much the owners have contributed directly. I mean, it can be in the form of share capital. Indirect means the profits that are not taken away by the owners, that are retained within the business in the form of reserves and surplus. How much outsiders have contributed in the form of debenture, preference shares, banks, suppliers, and creditors. Okay, so all this can be understood by going through the financial statements. Let's get the key points. Now, by going through the balance sheet, if we see that owners have invested a lot of money, say in terms of proportion, it shows the confidence of the owners. I mean, there is a threshold for debt equity we call as 3:1. It means debt can go up to 3 by 4, 75%. Equity should be at least 25%. It means we are saying equity should be at least 25%. But if equity is, let's say, greater than 25%, 30%, 40%, 50%, it means owners are ready to invest more in this business because they are confident that this business will generate profit. Okay, so more investment by owners indicates high level of confidence by the owners, so bankers can also take part in that business. But if the dependence on outsiders is high, let's say it is in the range of 3:1, like 75% of debt, we say that business is leveraged. And if it is going to be in the ratio like 4:1, it means 80% is debt. It means it's highly leveraged business, and that business has a lot of financial risk. And these business entities would become bankrupt easily if there is going to be some small fluctuation, some small variation in sales or increase in cost. So how this can be balanced? They should always ensure their debt equity ratio is in the acceptable levels. Similarly, we should also focus on the borrowings. How much is short-term borrowing and long-term borrowing? If a business entity has more short-term borrowing, then they will have high liquidity pressure because all those have to be repaid within a short period of time. It means the business is always pressurized to generate short-term funds for making payment for this short-term borrowings. But if the business has higher long-term borrowings, then they are going to have comfortable liquidity position because they are not pressurized for payment on a daily basis. Fine. So these are all the basic points which we should understand with regard to financial statements. In the next session, we'll take up real balance sheets and we'll see how to read balance sheets.